Let's look quickly at the second type of stock spread, and that's married puts. And again, with our three trade management rules, if we have a profit in a stock directional trade, then we'll use an option to protect those profits. And in this case, we're looking at the second type of stock spread, and that's married puts. And the married puts are created by purchasing 100 shares of stock and then purchasing a put option, and we normally purchase an at-the-money put option. So you can initiate this spread simultaneously by buying the stock and buying the put simultaneously, or you can leg into the spread. If you buy a stock and you have a directional trade that makes money, then at a later date, to protect those profits, you can leg into the spread by buying the put option. That's the way we normally set these up. So, and I trade these in my retirement accounts as well as the weekly covered calls. With married puts, the put option limits your risk. So if the stock is trading at $53 and you buy the 50 strike put, the value of the stock cannot go below 50. So once you buy that put, it locks in a value, a floor underneath that stock, and the value cannot go below the strike price of the put that you bought. So when you buy a put, of course, your profit is not limited or capped. So if the underlying stock keeps going up, you keep profiting if you buy a put option. So it doesn't limit the upside potential. Here's daily price movement, Amazon stock right here, and we can see it was on a buy signal. The 50-day EMA, the blue line, was above the red line. I waited until it retraced right here towards the middle channel, and I went ahead and bought 300 shares of Amazon at 449.01, and we can see that it rallied after this entry right here. It rallied in price, so I got a low risk entry, and then I had after this rally in the stock here, I went ahead and bought the 515 strike put option. So I had a profit in Amazon stock, and I was just following the money management rules to protect those profits. So I bought 3 of the 515 strike puts at 53.13. So the value of Amazon stock cannot go below 515 when I buy that 515 put. So as it turned out, after I bought the put, Amazon did, there was a sharp price decline in Amazon, but I had already locked in a profit by buying that put option, and that allowed me to profit no matter what Amazon's stock did at that point, because the total cost of the put in the stock, the total cost was 502 points, and my minimum profit was, or my minimum price I could sell Amazon was 515 because I bought the 515 put. So I was guaranteed, with a cost of 502 and a guaranteed value of 515, I was guaranteed a profit on this trade. So we'll look at some other examples of married puts over different time periods. We've been doing this for a long time. This is before Apple even had its stock split. We bought 200 shares of Apple, average cost of $339, and then we bought the 560 strike put at $43.50, and we developed a series of calculators that will calculate the profit potential for option trades, and we use these calculators before we enter the trade, and they'll give us the profit loss potential based on the price movement in the underlying stock. In this case, this is the married put calculator. Bought the Apple stock at $339.05. Bought the 560 strike put at 43.5. And what this will do is calculate the profit potential based on price changes in Apple stock in this example, from an 80% increase in the stock to 100% decrease in the stock. And this bottom row here will give us the percent return for this trade, and the second from the bottom gives us the dollar profit. So for each one of these spread trades, we can see if Apple stock was flat at 339. Remember, I bought it at 339. If it was flat at 339 at option expiration, I'd realize $17,745 profit and a return of 46.4%. So the put locked in a profit for us, and no matter what happened, even if it goes down 40%, 60, 80, 100%, we're still going to realize that 46% return. So in this case, by buying the put, we locked in a guaranteed return for our stock. And when you do that, once you buy that put, you don't have to worry about earnings reports or bad overnight news or anything like that. You don't have to worry about potential bear markets. You can just place the trade and forget it, because you're, in this case, I was guaranteed a profit. Here's another example. This is TJX. The retail store bought 2,000 shares at 30.48. That's a split adjusted, and then bought the 40 strike put at 249. So we like to buy the at the money puts to protect our profits, and that enabled me to lock in a $14,000 profit on this trade. And again, bought the stock 30.48, bought the 40 strike put at the money put at 249. If the stock is flat at option expiration, I get a 29% return. And if the stock goes up 40%, I still get 29% return. But look what happens if the stock really tanks. I'm still going to get a guaranteed return. So buying that put allows us to lock in a profit.